Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every single day. And as has been the case this week, we're talking about yet another company which has been very recently listed. This one is from the consumption space, but it doesn't cater directly to the consumer. It actually does cater to a lot of the companies from the diamond and jewelry space, and that is none other than International Gemmological Institute of India, IGIL as it is known as well. And this one basically, serves as a place from where you do get independent certification and accreditation services for, the fields in diamonds, gemstones, and jewelry. And it has about, pretty steady 65% market share in lab-grown diamonds particularly, and about 42% share in the jewelry certification segment. So it does have a lot of dominance in it, and it doesn't just have operations here in India, it has operations abroad as well. In fact, one of the objectives of the recently listed IPO for this particular company was also to take on the Netherlands and Belgium units under its own wing, which it bought over from its promoter. So, of course, we'll talk about that a little bit more detail a little later on. But for now, in terms of services that the company does offer, it includes diamond grading, quality evaluation, grading, and assessment. And along with that, it also conducts educational programs. So, think of it as this way. We do have rating agencies which actually takes on, rating of several financial instruments of, say, for example, a corporate, and it assesses, makes the assessment, and then issues a certification based on the risk that may be associated with that particular security of a corporate, and that's the role of a rating agency. Similarly, what this particular company does, it actually rates for example, a diamond or a set of stud jewelry, and gives you that certification, and it gives you just that much more of an accreditations which suggests the quality, will give you the quality of that particular piece of jewelry, or for that matter the diamond or a precious metal that you are purchasing at that point in time. And this is not necessarily just for consumers, but also it's more of a B2B process. But now that I've made a mention of what the particular company does, let me also tell you about how we in fact can address this, take this forward in terms of what the company has done. So as we always do, we consider the fundamentals of a company. So we talk about the income statement, we also address the balance sheet, cash flows and return ratios, some very interesting data coming through as far as these aspects are concerned, some very large changes coming in as well. Of course, we move beyond the financial statements, and then that's when we also address what's happening in shareholding, street credentials, valuations, as well as street coverage. It's a fairly newly listed company, so we don't have too much in terms of street coverage. Still, we have a handful of marquee brokerages who do in fact cover this particular company. We'll talk about that in detail as well. But as we always do, we start by taking a look at the fundamentals of the company, the financial statements particularly. And for that, let's get in Mahima Vachrajani, who will yet again shed more light into these fundamentals. So Mahima, good morning and thanks for joining in. Let's, as usual, start by taking a look at your operational metrics, particularly the top line and the bottom line, and the consequences.
Right. Good morning, Agam. So, before I move on to the metrics, just a quick clarification. This company follows calendar year. So, the comparison that we've made is calendar year 24 to calendar year 23. Now, in terms of the top line, revenue has seen a 3-year CAGR of around 42%. In terms of calendar year 24, the revenue stood at around 1,050 crores, and this was around 898 crores in calendar year 23. EBITDA has seen an overall 3-year CAGR of 35%, which stood at around 600 crores in calendar year 24. Margins have improved from 55.2% in calendar year 23 to 56.9% in calendar year 24. And net profit has also improved from 331 crore to 427 crore. And net profit has had a CAGR of around 35%, which is a 3-year CAGR. So in terms of 3-year CAGR performance and improvement as compared to calendar year 23, this is all in terms of all 4 metrics, it's a thumbs up for the counter. In terms of the calendar year 24 performance, in terms of performance metrics, number of reports for them went up by 26% odd. But in terms of the Q4 performance, revenue growth and PAT growth overall were lower as compared to other jewelry companies. IGI's revenue growth stood at around 6%. This is the revenue growth, and PAT growth stood at 4%. But this as compared to jewelry companies like Titan, Kalyan and Senco, especially Q4 being a festive season and a wedding season, Titan clocked a revenue growth of 22% and a 48% growth in PAT. Kalyan saw a 20% growth in revenue and 68% growth in PAT. In terms of the overall Senco Gold, also revenue growth was at 37%. So in terms of all of these metrics, the revenue growth came lower for IGI as compared to these jewelry companies. The other aspect which was important to note in Q4 was the studded mix for jewelry companies, because there has been a downtrend. Titan studded mix was down by around 1% YOY. Senco Gold stud ratio was also lower on the back of impact of lab-grown diamonds. So this might have a sequential impact on IGI, because they are the ones providing certification for natural diamonds and lab-grown diamonds. And if studded mix goes down for these jewelry companies, the number of certificates being issued by IGI will also go down. And lastly, in terms of Q4, muted revenue growth was probably led by high volumes in lab-grown diamonds compared to the natural segment. Company also claimed that they did not see any seasonality in terms of its revenue, but there was also a shutdown being observed for around 15 to 20 days in November to manage their inventory, which also impacted their overall revenue. So in terms of the 4 metrics, of course, it's a thumbs up, but Q4 was slightly saw a lower growth, and there was a shutdown as well.
So, we were actually on the fence on this one, or whether or not we should give this one a thumbs up or no. And look, there's no taking away the fact that the past few years have been very strong for the company. But Q4, particularly in this case, stood out. Firstly, because of the fact that they had to retract their statements and, well, reissue their financial statements for the 4th quarter of the calendar year gone by. The changes weren't very large. The changes were relatively small, but that, of course, was a concern. But more importantly, again, as Mahima has already mentioned, this is not a like-to-like comparison with all the other jewelry companies. It just shows you that if you do, in fact, have such strong growth for the jewelry companies, then why is it that this particular quarter has not been so good for IGI particularly? And of course, once again, as Mahima has mentioned about a handful of other aspects as well with respect to the studded mix, as well as, muted growth in the lab-grown diamond space. We need more clarity here. We need more of a picture in terms of how this mix has, in fact, changed with respect to the certifications as far as this particular company is concerned. So that's as far as your top line, your bottom line is concerned. And the hitch now is coming in the 4th quarter. Can there be an expectation of continuation here? Because we did see a lot of weakness after the company came out with its earnings. But, I talk about the balance sheet moving on, and it has, so firstly, its net worth, okay, that's the shareholders' value, has in fact gone from negative to positive over calendar year 2023. So that is, of course, a positive here. It does not have any gross debt, and in terms of cash in bank, those numbers have improved as well. But we'd also be very curious to understand how this particular net worth has gone from a negative 600 odd crores to a positive 1,000 odd crores. So that's something that we're going to keep an eye on. There is another aspect that we do need to address as far as its receivables are concerned. We would have given this one a thumbs up, but given the fact that we are also looking at a sharp increase in receivables. Firstly, in calendar year 23, there was 100% growth in receivables on a year-on-year basis at around 126. And even in calendar year 24, the receivables have moved up even higher to around 164. One might suggest that this is actually an implication of the growth in business. We do take that point. However, the fact that your receivables are growing and they're actually outpacing the kind of growth that you're seeing is a little bit of a concern just at this moment, which is why, of course, we're not going to give this a thumbs down. It's just one of the parameters we thought that we should highlight before we bring in your overall balance sheet details. So, and hence, it's going to be a neutral here. How are cash flows looking, Mahima?
Right. So, for cash flows, in terms of cash flow from operations, they have been improving. As compared to calendar year 23, where cash flow stood at around 303 odd crores, it has increased to 393 crores. This could have been a better number in terms of calendar year 24 if trade receivables did not, increase by the bit that we talked about. But still, cash flow from operations is a growing number. But in terms of net cash flow, the net cash flow in calendar year 23 stood at 55 crores, which was a positive number, but that has turned to negative 60 crore, and this is because of a 1600 odd crore cash outflow in the investment activities.
Right.
So we'll have to, even go to the management and see that where this money has been spent and why the cash flow has been negative in terms of calendar year 24, which is a 60 crore negative number. So because of that, negative 60 crore number, we've given it a neutral rating.
Yeah.
But overall, cash flow from operations have improved in terms of, in comparison to calendar year 23.
Right, absolutely. So that's as far as, this aspect's concerned. We talk about the return ratios too. Again, very healthy return ratios of around 48-50% for both ROEs and ROCEs. So there's no problem here. Given the fact that it has a very strong operational metrics in terms of your operating margins as well, these numbers are expected to remain higher. But let's talk about shareholding as well, Mahima. That's another interesting one, yeah.
Right. So in terms of shareholding, this parameter we've given a thumbs up because promoters have a strong holding of 76.55%, and this of course will come down to the 75% threshold that is required by law. But FIs are holding around 9%, DIs are holding around 5.8%, and around 8.5% is held by public. So in terms of the overall free float that is available to public, that's around 8.5%. But in terms of the pledge that we were talking about, just before the IPO, the fresh issue was for approximately 1475 odd crores, out of which 1300 crore was for paying off the promoters for buying off the Belgium and Netherlands part of the company. And the promoters had their pledge against that holdings, and that pledge is now, the encumbrance has now been removed if we check the as of March data. Right. So that has that's probably a big positive coming in for the company.
And who's the promoter, Mahima?
For them, the promoters are, if I'm not wrong,
it's Blackstone.
Blackstone, yeah. So Blackstone are the promoters, and so that's how the entire transaction has taken place, and which is why we've given a thumbs up for this particular counter. Right.
I just want to mention one more thing. There are a handful of sovereign authorities who also own stake in the company. So you do have Abu Dhabi as well as the Singapore, sovereign entities, which in fact do own about 1 to 1.5% as far as this particular company is concerned. Besides that, there are plenty of marquee AMCs in India as well who do have ownership in this particular company. So we have a well-rounded institutional involvement in this particular company as well, notwithstanding Blackstone. The only issue that we perhaps need to understand is that the shareholding still shows encumbrance. And of course, this is shares pledged to Deutsche Bank. So we will get more details and clarity from the management on this one as well. But, moving on, I will talk about street credentials. And when it comes to this one, look, we know that it's been a tough period for the mid-cap and the small-cap companies here as such. And this company has also been a victim of this precipitation that we've seen over the span of the last 5 months. The stock has, of course, listed at 510 on the NSE, and that was at a premium of around 22%. And since then, it has come off quite a bit. In fact, today, it's trading at a little over 320 odd rupees per share. So if you, as you can imagine, that we have seen that correction, a very sharp correction as well. And well, one of those companies which in fact have taken it up the chin, along with a lot of the other IPOs, which did show a premium on listing day, but have since come off significantly from not just their issue price, but also their listing price, whether if you consider the high or the low. But you know, in general, otherwise, not much to talk about. That's how, well, street credentials are. Mahima, how are valuations looking?
Right. So for valuations bit, if we see the estimates for 2025 as well as 2026, the P ratio for IGI for 2025 estimates suggest that it's at around 42 times, and this will go to around 36 times. So not looking very cheap, although IGI has no direct competitor. So there is no peer comparison for this particular counter. But overall, if we see the kind of valuations that are being pegged at in terms of estimates, the EPS growth suggests a 20% growth versus that of a valuation of 42 times and 36 times in 2026. Revenue growth is pegged at around 15 odd %, and overall FY26 estimated price to earning growth is just at 1%. So you know, if we see all of these metrics, the counter looks a bit expensive, which is why we've given it a neutral rating for now.
All right. Well, there you have it. So that's your, you know, price to earnings valuation. Of course, as Mahima mentioned, the PEG ratio is at around 1. So it's a fairly neutral one, you know, keeping the growth in mind. And we're penciling at about 20% growth here. Well, that's as far as your PEG ratio is concerned. That is price to earnings to growth. But finally, actually, Mahima, why don't you take us through the analyst recommendations as well? We just have one right now, Morgan Stanley, who incidentally, by the way, were also their book running lead managers here. They have, in fact, after, you know, a few weeks after the company listed, have also made an initiated note on this one. What are they saying, Mahima?
Right. So, so Morgan Stanley has initiated coverage, as you rightly mentioned, and the target price that they've given is 617 for this particular counter. What they're saying is that for IGI, there are high barriers to entry, and that is the key moat. In terms of an India production story, in terms of lab-grown diamonds, they are not there yet. But overall, India consumption story for natural diamond remains intact. They're expecting IGI to deliver a 15% and 20% revenue and PAT CAGR over calendar year 24 to 26 estimates. They're expecting EBITDA margin expansion from 54.6, that is in calendar year 24, to around 56.9 in calendar year 26. And you know, just to mention, they've already done margins of around 56.9% in calendar year 24 itself. In terms of P, the target P is of 60.2 times, 47.5 times, and 23.8 times is the bull base as well as bear case scenario for this particular counter. So overall, they are you know, bullish when it comes to this counter, and which is why we've given a thumbs up. This is the only broker that right now, you know, kind of has a coverage on this particular counter, because it's a recent listing. And so overall, because they've initiated and they're overweight on this particular counter, we've given it a thumbs up.
Okay. All right. So I reckon that this is a good time to get the management in. And we, in fact, do have Tehmasp Printer. He is the MD and CEO of the company, along with Eashwar Iyer, the CFO, who is joining us on the show. Good morning to both of you, and thanks so much for joining us here. And well, Tehmasp, I'll start with you. Now, overall, over the last 3 years, we've seen stupendous growth for your company in terms of your top line as well as the bottom line. It has been very evident, the growth. But the question really is that the fourth quarter did throw a little bit of a concern with respect to at least the near-term growth looking forward. And, you know, I know that this is not a like-to-like growth. While the industry and the jewelry retailers have done very well, that hasn't exactly translated for the growth of the quarter gone by. I'm not talking about the entire financial year. One, is this a good way to look at things? And two, if you could also tell us about what has contributed to the growth, or rather the at least perceived lack of growth in the fourth quarter. If you could give us a little bit more detail here.
So basically, IGI is a growth story. We have delivered growth over the last many years. And if you see the year-on-year, our growth is at the levels that we specified, even initially. So it's just in the last quarter there was some bit of correction, because the LG diamond prices were at I mean, they were under pressure and, we were holding on to our certification costs for at least 6, 7 months. And finally, last year in around April, May, we had to take a 20% cut to correct the incremental um, certification cost per LG diamond. So initially, while we used to certify 30 pointers, the demand, because of the affordability of the LG lab-grown diamonds, we are now averaging 1.5, 2 carat plus. So the bulk of the certification now is coming through the higher weight of the lab-grown diamonds. So while there has been a price correction, at the tail end of the year, we have adjusted. But if you see the overall picture, we are on par and in fact going beyond.
Okay. So at the moment, Tehmasp, my question then is that are you likely to see more of a shift towards certification of lab-grown diamonds as compared to your traditional sources? And keeping that in mind, do you think that there could be any issue with respect to profitability? And by that, I mean your operational metrics.
See, the thing is, both are diamonds. You have to understand that lab-grown is a new kid on the block. It's a disruptor. The diamond market never had a disruptor in the last 100 years, okay? And at IGI, we were very cognizant of the fact that we are an independent international certification body, and we will give analysis of any stone, gemstone that we are paid the fee, we will honor it. It's our integrity that counts. So it's not that, we have a bias towards natural or towards lab-grown. And because of this factor, we have taken the lead in the lab-grown sector. And we have today around 65% of the global certified diamonds of lab-grown certified by IGI. At the same time, we are not B-grade diamonds. So natural is also for us. Lab-grown is also for us. The most important factor here is to determine the origin of the diamond, and which we have a legacy of 50 years and we have the expertise. Because, both the diamonds, chemically, physically, crystallography, both are made of carbon. You and me are made of carbon. So everything is very similar. Is the same rather, not even similar. So to identify the different origin, one is earth mined, one is man-made. And that requires a lot of expertise, and IGI has that. And we have used this expertise because the only difference really between the two diamonds is the commercial value. One is considerably affordable and one is very expensive. So, what lab-grown is actually doing right now, is increasing the consumer base. The millennials and the Z generations, all aspire to have a diamond. And today they have an affordable alternative. They have an affordable diamond. That's what I'm trying to say. And this is where we see the industry progressing with a huge number of consumers coming into the fray. If you see statistically, 1.5% of the Earth's population buys diamonds.
Right.
And yeah, right. These are all natural.
Got it.
Today, with the price points and affordability of lab-growns,
right.
This is fast expanding.
Got your point. Right. Got your point, Tehmasp. Eashwar, I'll come to you. Right now, what is the mix like, lab-grown diamonds versus natural diamonds? I just want to get my facts straight here. What's the mix like, one thing, and what is the actual difference in terms of percentage when it comes to, the price that you're charging for a certification of a lab-grown diamond versus that of a natural diamond? Because then I want to understand the impact, overall impact on your bottom line.
Okay, so Mahima, I've been listening to the detailed analysis that you were presenting. It's very, very comprehensive. So, it's awesome analysis that you've actually done on the
Thank you
IGI
so much.
performance. So let me just set a few things in context before we get into the nitty-gritties of the question that you asked. Okay. Okay. There was one discussion point. I'll just move away from the financials for a moment in terms of the shares that is being pledged by Blackstone. There was a clarification that we had given even to SEBI prior to our listing. There is at the moment, or even in the past, shares that are never been pledged by Blackstone. So I just want to put that record straight so that there is clarity amongst everybody who is watching the show. So there are no shares have been pledged by Blackstone, and Blackstone holds close to 76% of the company post the IPO. Yeah. So number two, in terms of what's happened for the business for the last 12 months, and then we'll talk of the quarter. The business, there was a couple of things that we did as part of the IPO process. There was, as I know, as Tehmasp did mention, we have been in this business for over 50 years. We operate in 8 to 10 countries. We had three holding structures. We had a holding structure in India, and Belgium and Netherlands. As part of the IPO process. IGI India is now the holding company for the group. We've acquired both the IGI Belgium as well as the IGI Netherlands business as part of the commitments that we made in the RHP. So close to 1350 crores of funds that is which came in from the IPO. We used that around 1300 crores of that plus another 60 crores from our bank to fund the acquisition of both Netherlands and Belgium. The critical aspect here is the brand was always owned by Belgium because that's where the business started. And through this acquisition, now we have also the brand directly under the ownership of the listed company in India. Okay, so that's an important point that I just wanted to bring to your attention.
Right.
Now coming financial performance, of course, we've grown close to 17% from a revenue standpoint for the full year. And that is on the back of about 27% volume growth. So the key volume growth that's happened for us over the last 2-3 years is driven by the lab-grown segment, which Tehmasp mentioned being the new disruptor. So that's become, it's a category which is affordable with the pricing structures that is available there. So that is the key driver of the volume growth as well as corresponding revenue growth.
Right.
Now, of course, what's happened is because of the nature of the industry, while natural diamonds are scarcer, it takes over 1 billion years for it to build up in the Earth's crust, etc. Then lab-grown diamonds is man-made. So we have equation of demand and supply, therefore playing out as far as lab-grown diamonds are concerned. And the lab-grown diamond therefore saw a correction on pricing, either from the Q4 of 2023 till the first quarter of 2024. Corresponding to that, we had to therefore correct our certification pricing. And to just answer to what Mahima just mentioned, our certification is around 3 to 5% is what we charge as certification if you were to compare to the pricing at the wholesale level.
Right.
So pricing impact which we took in the month of April, May, consequent to the price correction at the lab wholesale level is what caused a little bit of softness in Q4 because the Q4 of 2023 was also extremely strong from a volume standpoint.
Right.
And the other point that Mahima asked in terms of our business mix at the moment, equally between lab-grown as well as natural diamonds.
Okay, well, Eashwar, unfortunately, we are completely out of time. So we've registered all the clarification that you made with respect to encumbrance as well as, how business has shifted and also the kind of correction that we've seen in terms of, the price correction that you have taken. So all the points taken on board. But at this point in time, we are completely out of time on this edition. So thanking both of you for joining us and taking us through, all the parameters with respect to your business. But on that note, it is also a wrap on this edition of KYC. Lots more lined up on the other side. Stay tuned in.